So do you want your friends to think you're smart? Of course you do. Well, then you should trade options. More specifically, you should sell put spreads. Let's go! So quite a few people have messaged me and said, hey Jimmy, what are put spreads? How do we trade them? What can we do? So I thought, let's make a video about it. Let's explain it, break it down, then you can ask questions in the comment section and we can move on from there. So if you found this video useful, hit that like button. If you're new to town, hit the subscribe button. We'd love to have you stick around for a while. You can also check us out on Instagram off the banner of the YouTube page. And if you're super curious, you can also hit the Facebook icon, come over to our Taking Trades private Facebook group and join us. So back to the put spread. A put spread is a risk-defined trade that involves selling a put option and buying a put option. Now, the selling of the put option is where you collect most of your money. Buying of the put option is where you get your protection to the downside. Now, a lot of people have been very nervous about trading options and said, hey, I don't think I'm that interested in it because I've heard that a lot of people have lost a lot of money. Well, people have. Size gets too big, liquidity gets bad. There are some reasons why people lose money, and in my opinion, large sums of money are lost when people are trying to hit home runs. What I like to do is just base hit after base hit. It's not sexy like day trading. It's just singles and it's every day. And after time, the profits add up. Now with a risk-defined trade, one nice thing is you're protected from a catastrophic downside move, a true black swan event. You're protected by the put that you purchased. Now we're gonna hop over to the whiteboard and I'm gonna show you a schematic just to kind of break this down and visually make it make sense. And if you have more questions beyond this, just drop in the comments. I'll get back to you. Let's hop over to the whiteboard.
All right, we're going to keep this example super simple just to get the concept. So details and getting into sort of the layers behind the put spread and some of the logic, that could come at a later time, but this is just the base fundamentals. If you have questions that are a little more detailed, you can drop them in the comments below or pop over to the private Facebook group and join us, and you can ask questions there and we can discuss more. But for right now, what I want to do is I'm just going to draw a line, and we're going to pretend like this is the stock price action, okay? So our stock is heading up, pulls back, starts to head up some more, and you identify this and say, okay, I think that's an uptrend. I don't think it's going to go much lower. So what you want to do is make a bullish bet. What you can do is sell what is called a put spread. Now, the put spread starts off by selling an out-of-the-money put. And what that means is this line here and above would be considered in the money. Price action moving upward is in the money. Now for a put, anything below this line is considered out of the money. And if you look at the options chain and open that up, you'll see what I'm talking about. Anything that is higher on the put side in terms of price or higher is in the money. Anything below on the put side is out of the money. So right now, let's say that you in your mind decide, I don't think that this stock, let's just call this stock X. This can be US Steel for right now. We're going to say X. Stock X is not going to go below 35. So you're saying, I don't think it's going to go below $35 a share. And let's say in the next 45 days. You choose 45 days. I'm going to type that right here. So we're going to say our expiration is equal to, and let's just say 45 days. Now, this will just kind of keep things consistent. Now we know 45 days. When we refer to expiration, just assume I'm talking about 45 days. So you choose $35. Now, $35 for the put that you're selling, this is going to be the strike. So right here, I'm just going to say sold put strike. And that way it'll just stay clear. So the sold put, this is the strike, okay? Now, what you're saying is you don't think price action is going to go back below $35 and it's going to continue to move higher. So that's great. You'll collect a credit, and in this case, let's say for this you collect, let's call it let's say to make it easy, you collect $1, okay? So you got a $1 premium per share, and remember, you have to do 100 shares because one contract is 100 shares. It's the smallest size you can have for one options contract. So you get $1 per share for selling this $35 put, this $35 strike. Now, as long as things go up, everything's gravy and you'll keep gaining this dollar back. So what a lot of people will do is, as the price rises, they'll keep monitoring how much they can buy that put back for, because you sold this to open and you have to buy it back to close. Now, ideally, you would buy it back for $0 and collect the whole dollar, but that can take the entire 45 days and tie up your money. So what a lot of people will do is they'll close the trade early, maybe at 50%. So say the stock continues to move to the upside, just like you thought, here it goes, and you get to here, right in this area, and let's say that you can buy it back to close for 50 cents. So you would subtract your 50 cents that you can pay to buy this back, and your net profit is going to be the 50 cents. So yes, you collected $1 up front, but you paid 50 cents to close. Now this is totally up to you. Some people choose to close it at 50%. Some people like to go 75%. Some people let it go all the way to expiration and they collect the whole dollar if they're right. Now if they're wrong, they won't. But let's take care of that now. What if you're wrong? What if the stock does not continue to the upside and it retraces on you? Now just to keep things sort of clear here, I'm going to go ahead and erase this guy. So let's just say, for clarity's sake, that instead of going up, the stock then does this. Okay? So you're saying, oh, everything was great. I collected $1. I made $100 because I had 100 shares, and now it's tanking on me. So what's going to happen now? Well, when you're selling a put spread, you don't actually own the stock to start off. So if you're below $35 and you hit the 45-day expiration, you can be what is called assigned. And that just means that you're obligated to buy 100 shares of stock from another party at $35 at the strike price. Now, you might be at $25 currently, but you still have to buy that stock at $35. So you would immediately be down $10. Now this is where the put that you buy comes into play. So the sold put, collect $1, you want it to go up. Now you're going to say, okay, what if it goes down? Where is my protection in that case? So let's say that you decide to choose that you want $30 to be where you buy your put. Okay, so that's where you bought your put. And we're just going to say the bought put is right at this red line. So this is the bought put, and this is going to be at $30. So now you have a sold put at 35 and a bought put at 30. So what this means is your risk tolerance, your risk that you're exposed to right now, is actually from 35 to 30. This is where you hold risk, just this $5, because a put that you buy gains money as long as you go below. So if your put that you bought was at 30, then you're making money as you go to 25, you're making money as you go to 20. It makes money as you go lower. Now the put that you sold loses money as you go lower. So you need something to offset the loss. So as it goes below 35, you're losing money until you get to 30. Then below 30, you're break even if it goes to $0. You're break even because you're losing money here, but you're gaining money here. They're offsetting each other. So this is why it's called a risk-defined trade. And I'm actually going to put that right up here. This is a risk-defined trade. So yes, you can lose money, but only between $35 and $30. Now, a lot of people will also manage these trades at 21 days to expiration. So 3 weeks before it expires, they'll make a decision. Do I want to change the trade at all? Called rolling, and we're going to get into that in the next video. Right now, we're just going to stick to what a put spread is. So you can make some decisions earlier before expiration, and that's one way to help avoid being assigned those shares early. Because yes, you'll be assigned if you're below 35 when you expire, but there's also a risk that you could be assigned early by a party because they can assign you anytime. It's not as likely, but it can happen. So sometimes you have a surprise assignment. Your price is hovering at $33 and you're 2 weeks out, and all of a sudden one morning you get up and you've got 100 shares of X at 35. It just happens sometimes. I have to say it's not very common in my experience, but it does happen. Now, if it then tanks below here, you've still got your put that you bought in place, and that protects you to the downside. So, put sold at 35, put bought at 30, and your risk zone is between 35 and 30. So to make this even clearer, I'm just going to erase a couple of things off our screen so it's a little easier to see. And if you can get this basic concept of when you sell a put, that's bullish, meaning you want the shares to go higher. You want the price to go higher. Now, when you buy a put, that's bearish. You want the shares to go down to make money. But in this case, when you purchase a put option, it's the protection to the downside. You want to make money if it happens to drop in a black swan event or something catastrophic where it drops really bad overnight. You get up in the morning and it's gapped down heavily. So your protection is beyond $30. So risk defined. However, the risk that's present is that you can be assigned if you're between 35 and 30 or below 30, and it's before your expiration. That can happen, just to let everybody know that risk still exists. It's happened to me. It's happened to people I know. It's not very common, but it is out there. Now, to clean up any loose ends on this, you might be wondering, okay, so I sold this $35 put. I sold it for $1 per share, but what do I get paid for the put that I bought? That's a good question, and we're going to draw this out. So let's say that you sold the put and you got paid $1, okay? Now, you have to subtract the put that you buy because you're buying it. Let's say you bought this put for 30 cents, okay? That's the put you bought, which is going to equal a net profit of 70 cents. That 70 cents is what you're going to put immediately in your account, and they can't take that from you. That's the premium we've been talking about. You get paid the $1, you buy the put for 30 cents, you subtract 30 cents from a buck, you've got 70 cents net profit. That goes in your account, you hold that, and you wait and see what happens. Now, out of that 70 cents, if you decide to go ahead and close your position early, you just have to make sure that what you close it for is cheaper than what you collected in order for it to be a winning trade. Now, we'll get into deeper discussions on when to close trades, what percentage you can use to close the trade. Should you hold it all the way to expiration? Should you try to get the full amount, your full 70 cents? Why you shouldn't? And we'll get deep into more discussion about that. But today I just wanted to introduce this topic. And if you want to find more information, go to tastytrade.com and search for put spread and watch some of their free educational content on the put spread, because they'll get into some very, very detailed statistics and probabilities about why these are good trades in some scenarios and why they're not good trades in other scenarios, which we're also going to get into in future videos, because one big component missing from this video is discussion about volatility. You sell put spreads when volatility is high, and we're going to talk about that in another video. This is introductory to the put spread. I hope it was helpful. Happy New Year's Eve. I'm excited about the Facebook group. Come over and join us. We're about 34 people strong now and growing. I'm excited to see all the interactions on that platform. Also, feel free to check us out on Instagram, right on the banner of the YouTube channel. You can go there, follow us on Instagram. We're posting every day about the trades we're taking, sort of logic sometimes about what we're seeing in the markets. And I just like to hear from you guys what you're trading. So hope you guys have a safe New Year's Eve. Hope the video was helpful. If you like it, give it that like. If you're new, try us out and subscribe. And we'll see you next time.